Hey everyone. In today's episode, I'm going to discuss why the Melbourne market is presently an anomaly. The reason for doing this episode is because I get a lot of people calling me on a weekly basis, even some Sydney-siders that I've done business with literally for years. And I kid you not, some of them are still hesitant about the Melbourne market, but I actually expect the Melbourne market to be by far the best performer in the next 10 years. And the reason for making this episode is actually to show you that it's complete anomaly and your best opportunities are literally all ahead. And some of the best ones have probably already been taken, to be honest, because the market is already off its bottom. But in today's episode, I'll get into a few things. So first of all, I'll just narrow out the definition of a market anomaly, explain to you some of the market anomalies that are present, then go into also generally the reaction to market anomalies, and then finally go into the best regions in Melbourne to purchase in this present environment. Look, a lot of people don't know what a market anomaly is, but all it is simply it's a deviation away from the expected behavior of a market. It's as simple as that. So it's generally a stock market term, but to give you an idea, like it does happen in the property market, you do generally get markets that do completely underperform as to what they're supposed to in the short term. It's actually short to medium term. It depends on the market, really. And they do create a thing called anomaly. So it's completely abnormal. It presents great opportunity. And that's why I'm making the episode today. So to give you an idea as to why it's in a present anomaly, let's just start with what's happened kind of since COVID. And really in Melbourne, it's not only since COVID, I'd actually argue it's since late 2017, early 2018, because the Melbourne market finished its last end of the cycle and it didn't really do anything from then till about 2020. It was pretty much flat in those 2 years. So you can probably add 2 years to this graph. But since COVID, really, you can see Melbourne's performance there. It's done literally this. Now, this is CoreLogic data, mind you, so I'm not making this up. But you can see as of early 2025 there, Melbourne has literally done only around 10% growth. We need a lot of the other capitals doing around 30 and some others also doing 70 to 80% capital growth. Now, this number, mind you, already now is probably about 2 to 4% above where that graph line is. And it's simply because we're a few more months into the year and pretty much every city has had a slight bit of growth since then. So just to give an idea, that's how much Melbourne has actually underperformed in recency. And this graph, as I said, you really need to take it out to about 7 years because Melbourne didn't really do anything between 2018 and 2020. So that's where Melbourne's kind of at. And furthermore to that, this is why it's a market anomaly. If you look at the long-term price trends, so these two graphs to give you an idea, or should I say data points, one's the Aussie Home Loans 25-year report, the other's a CoreLogic 30-year report to give you an idea. So I'm not making this data up. You'll see on the left here, by far the highest capital growth city is Melbourne. By far, you can see 8.1% capital growth average. Sydney, second place behind that. And now don't get me wrong, sure, like Melbourne did have a good run to that period, but we are talking over 25 years. We're not talking as though this is just taking in, the boom of 2013 to 2017 in Melbourne. We're talking about literally, 21 more years on top of that. And on the right there, you can see, so this graph actually came out in 2022. So this is actually after, as I said, Melbourne didn't really do anything in the years between 2018 really and 2020. It did have a small dead cat balance, obviously because of COVID, but only about 10%, so not much, right up to 2022. So this is actually encapsulating some of that period where Melbourne didn't do anything. And you can see the consistency just there of Melbourne alone. That was our best capital growth city. If anyone wants to search that up, just search up CoreLogic 30-year report. You can find it on Google or any other search engine quite easily. And it was our best performing capital city. So historically speaking, Melbourne's actually the best performing capital city, although it has been the worst performer in recency. So you can already see what I'm getting at. And it's actually been the worst performer for quite a long time as well. Now, to demonstrate what I'm talking about as well, I'm actually going to compare this to different cities. And the importance of this is actually showing you the general ratios of what Melbourne is generally priced to other cities, because it's really important to understand that as well and where things are at in cycles. So first things first, I'm actually going to compare Melbourne to Adelaide, Perth and Brisbane. And yes, in this graph you will show Sydney, but I have a much better one in Sydney to show you later. So you'll see here generally Melbourne does outprice between it. Look, it shows here between 20 probably and 30% on average. It would probably outprice Brisbane, Adelaide and Perth depending on the city you're in. Although, if you actually go back further, so this graph doesn't show it, and I couldn't actually get PropTrack to show me it, unfortunately, but I actually did a bit more analysis, and Melbourne generally will price all of these areas actually on average somewhere between 20 and 50%. If you take only houses into that, I mean, because this is saying home prices, I mean literally detached houses only into that, Melbourne will actually outprice these areas even more. It'll generally be somewhere between 40 and 80% on average. And this is data since the 1990, so technically since 1992, so 33 years worth of data. But you can see there, basically every single city is abnormally priced compared to Melbourne. Most of these cities are actually more expensive than Melbourne at the moment. Now, I will put a caveat to that. These are just saying home price dwellings. They're not including detached dwellings, which is the only thing I actually buy. Melbourne does slightly outprice all of these cities on that alone, but still it is abnormally priced compared to the actual historical ratio of all of these cities. So let's just get into the final one now. Melbourne doesn't generally correlate with Brisbane, Adelaide, and Perth. However, it does have fairly strong correlation to Sydney. So if you look at the pricing ratio just to Sydney alone here, you'll see here that the average houses pricing ratio is very, very cheap compared to Sydney. Now, what I'm showing you here is the decade average is actually only just around the late 20s, so it's about 28 to 29%. However, it is right now above 40% in Sydney, and that's an area it actually correlates to. So what I'm showing here is Melbourne is literally cheap to every single city that we have in Australia, every single one of them, even the one it correlates to in Sydney. So it is showing you that it's actually one of the best places to buy simply because of the ratio and where everything's at. So that's the reason it's literally the best place to purchase in the entire country, one of them. And it's a complete anomaly because usually Sydney and Melbourne market do correlate very closely, but you can see just there recently, they're not correlating exactly how they do, but this will catch back up. Now, as I said, like Melbourne actually, this graph isn't as accurate to Melbourne as you probably want it to be, because I would argue it's actually about a 25% to 24%, maybe 24 to 25% long-term average. This only shows you since about 2015. If you go in the years before that, it actually even shows stronger. So if you especially go in the years between 2003 and 2008, it's actually under the 25% mark, and it's well under. It's more closer to the 20% mark in some years there. So that's another reason why Melbourne is very, very well priced. Ratio-wise, it is excellent, and I can't think of a better ratio to any other city in Australia than Melbourne. Let's get into the reaction to market anomalies. So what everyone needs to know is generally the reaction in markets is a mass overreaction. So, and that goes both ways. So generally when a market is, let's say, overpriced and the people start to peter out of the market, generally everyone peters out at the same time. And generally when a market is completely underpriced, everyone will come in at the same time. So everyone piles in at the exact same time, and it's like a market frenzy. It's the perfect example of FOMO. So I'm actually going to show you 4 different cities and when this has happened to all, and to show you it is a very consistent thing that actually happens in the market. So let's just start here with Brisbane and Perth. If you want to look just on the left of my screen of here, you'll see that in Perth, basically in the 90s to kind of early 2000s, you had almost no growth, like very, very, very little growth there. And then you basically had an economy picking up and a major, major, major boom there. Mind you, Perth is known for doing crazy numbers in a short period of time. So this is not uncommon in Perth. If you were to look at the actual graph as well and do it to 2025, you'd have probably a similar kind of thing happening here as well, but it's easily demonstrated more on this graph. So that's why I'm showing you it. But that's generally what happens in markets. So as I said, no one will go into a market, everyone will be scared, and then what happens is everyone piles in at the same time, and you get an average, like it'll absolutely obliterate the averages, and then what will happen is when it slows down, it'll kill the average, and it'll go well under the average, and that's what makes an average price growth. So as I said, if a market on average does something like 7 or 8%, what you'll get generally is a period of like 4 to 7 years worth of maybe 120% growth or something like that. Something around that, and then you'll get maybe somewhere between 4 and 10 years, depending on the market. In Perth, it can go up to 12 like this, of next to no growth. So, and that in the end makes the average. So that's what you need to know. And that is no different somewhere like Brisbane. So you can see on the right here, basically a period from about 2007, almost the whole way up to about 2019 of next to no growth as well. However, Brisbane's economy in the later parts of the 2010s was actually doing not too badly. You had quite a few businesses from Sydney and Melbourne actually moving up there. And the economy actually doing quite well, especially relative to income as well. So what happened there was basically you had a very strong underlying market there. A few people who were smart were getting in early, but a lot were waiting for all of the news to tell you what was going on. And that's just normal. People are sheep. They follow the herd. That's just what they do. And you can see that just growth there. That's like, I think 28 or 30% in a year or something in 2021. And it's continuing now. It's still going up. Brisbane, it's not getting any cheaper. So that's another good example of what happens with overreaction in the market. Generally, the herd follow the herd. Now, this is no different. Even like somewhere like Hobart, look on the left here, you had basically no growth from pretty much 2005, 2006, the whole way to about, let's call it about 2014 there. Then you had an incredible boom right up until about, I'd say, late 2021. You can see all the growth there now. Hobart, don't get me wrong, it has a smaller population, Tasmania in general, and it also has a smaller market base. And yes, that people don't earn as much money there. 100% that's true. But still, if something, let's say, does on average 6.5% to 7%, which it does, Hobart, to be fair, and it has done nothing for literally something like 10 or 11 years, it is probably going to grow a lot in years, should I say, preceding that. And it's because it will revert generally to its long-term average. So that's simply just the market catching up to its long-term average. Nothing more than that. That's why you can see what's going on. Now, I'm going to also compare Sydney to it because Sydney does correlate to Melbourne quite a bit. So you'll see here basically it's probably about 2004 and right through to around 2012, you had very little growth also in the Sydney market. And this is the general Sydney market. Sure, some went up a lot more. I get that. 100% I understand that. But then you'll see from about it would be about late 2012 right through to about, I'd say, 2017, 18. You had a very, very large boom in Sydney. So it pretty much doubled between that period. And that's only about 6 or 7 years. It's not actually really that long. And look, yes, it went up again after that, but I actually would say that was generally because of a dead cat bounce, and it's because we had basically 0% or 0.1% interest rates. That's the reason it went up a lot more. And Sydney has kind of petered out since your 2021-22 boom. To give you an idea now, yeah, it probably will do a few little numbers, but I mean, that's kind of where it's at, and that's what happened in Sydney. That's after a long period of doing nothing. So it does happen in the Sydney market as well. Don't get me wrong. So we've seen all of this before. We've seen every single bit of this before. It's no different to what has gone on in the past, and the same thing's going to happen in the future. Now, let's get to the market we're focusing on in Melbourne. Melbourne, believe it or not, is actually our most consistent performer in the whole country. It has been pretty much since its inception. It has the lowest standard deviation of any city that I've done any pure numbers on, especially on detached houses. Now, not only that too, but it also has the lowest swings generally between the top and the bottom. You can see just here pretty much since the early 90s how consistent of a performer that is. Now, if we extrapolate, that number right out, should I say, to 2025 like we're in now, it's basically done next to nothing. It's done literally around 10% since then. It's done almost nothing. However, it's our most consistent and best performer. So this is another reason why, both on pricing and also not only pricing, but also long-term market performance and underreaction than overreaction, why Melbourne's going to be our best performing city. I'm telling you right now, when it goes, it'll really go and everyone will FOMO in. That is exactly what's going to happen. And a lot of people don't see it, but it's exactly what is going to happen. Now, look, despite, obviously, don't get me wrong, Melbourne has an awful government. They are socialist, they are shit, they don't know what they're doing, I think they should literally be arrested for what they've done to the state. Honestly, I do, because they're the worst government I think I've seen in living Australian history, literally the worst government. Now, a lot of Melburnians will say that, yes, the state has a lot of debt. Yes, the economy is doing badly. And don't get me wrong, yes, we have very bad governance at the moment. And don't get me wrong, yeah, that may continue, no doubt. But really what we need to look at is the actual income of the state and what's actually going on there. So this is between 2019 and 2024. So this is the median weekly earnings in people's main job. Now, that's by state and territory. So you'll see here the highest earners to the lowest earners. So you see Victoria right there. And you'll see just highlighted in the bottom here of the state capitals, Perth had the highest weekly earnings of $1,500 per week, followed by Melbourne and Sydney at $1,450 and $1,416 per week. Now, something you need to know about this is Perth is very high, mainly because of mining and it's mainly resources. So Perth alone, don't get me wrong, I do own in Perth, but it is very resource dependent. So there is inherent risks with buying there. Sydney and Melbourne, the difference between Sydney and Melbourne, Sydney siders do earn more than Melburnians in general, but this is what this is doing is it's actually comparing the whole market here. It's not actually saying whether a person works full-time or part-time or it's just a casual job. They're just saying how much they earn per week. But regardless, what really you need to look at here is Melbourne's still actually quite high there. It's very high because Melbourne's also, Sydney and Melbourne are the most diversified cities in terms of employment by far in Australia, by a country mile. Now, they're the main two ones you want to look at long-term, to be honest, and it's because of the diversified industry there and the international demand of the industry there, right? Now, if you look at the actual, this is an ABS actual graph here, and you look at the 2019 actual number and then the 2024 number. Now, mind you, this is despite Melbourne having its worst economic performance pretty much since the early 90s, right? Pretty much since then. Now, if you look at the growth rate of that, it's higher than anywhere in the country by a long way. It's quite significantly higher than anywhere in the country. So yes, Perth did grow from $1,200 to $1,500, but Melbourne grew, so that's $300, but Melbourne grew from $1,073 to $1,400. Now, that's what, $327 there. Now, you got to think as well, it started from a lower base, so the growth rate is significantly high. In literally its worst financial time, pretty much since the early 90s. Now, for people that don't know, the early 90s, Melbourne had a lot of issues as well. Very similar to today, it had high debt, quite also a bad, I'd say, state economy, and it still did between literally the late 90s and early 2000s. It did like more than 100% growth in those times. By the time, it hit literally like 2008 to 2010 really, it had done, it's something ridiculous. It had done like 150% since 1997, 1998 in like 12 years or something like that. So this is what I'm talking about in terms of markets being underpriced but despite having quite good numbers. So people aren't seeing this. Yes, you have a terrible government. I'm not saying you don't. Yes, you have a lot of state debt, but really that will turn around. Victoria will not be the worst one forever. Yes, it might be for maybe now and a couple more years, but it will turn around, and Melbourne's still Melbourne at the end of the day. That's why you get numbers like this, despite everything that's going on. Now, furthermore, on top of this too, what you need to know is the future undersupply of Melbourne is one of the highest in the country. So this is Matusik data going right up between 2025 and also 2030. So this is just showing you the undersupply. And the one you really need to know is, so the four columns you have here is, first of all, the supply required. Second of all, the supply that's getting built in. Third column then is the number of undersupply, and the fourth one is most important, that's the percentage of undersupply. So you'll see clearly alone here, the ones that are most undersupplied is the ACT, Northern Territory, Tassie, New South Wales, and Victoria. So really what you need to know here is that if you want to know where the market cycles are at, Melbourne is probably at the best point of its market cycle now. It probably was a couple of months ago, to be honest. You had even better buys then because it was already off its bottom. But yes, don't get me wrong, the two most diversified states are New South Wales and Victoria by a mile. Yes, New South Wales is more undersupplied slightly than Melbourne, but New South Wales, the difference you'll have is that you've got quite a large Sydney Basin region in New South Wales, so it's right from Newcastle right down to pretty much Shell Harbour. That's your Sydney Basin region, so that would be included in this. And most of the undersupply will come from that, don't get me wrong, but it's spreading out across Sydney. Melbourne is predominantly all Melbourne where everyone lives and all this undersupply is coming from. And it's also a better point of the market cycle. It's also a lot cheaper compared to Sydney. It also has had better growth in terms of income despite being in a bad position. So a bit of policy change and a bit of, should I say, better governance, which they might do, will change that, I think, immediately. Despite that, with how cheap it is anyway, it's going to grow. It's just how things are. And also with interest rates coming down, it will grow as well, regardless of what decisions are made. I can tell you that right now. So that's another reason you're going to see growth in Melbourne. Now, furthermore, a thing you need to know too here is that the resistance trend line has actually broken. So for people, a lot of people that I work with will understand what I'm saying when I'm talking about this, but a resistance trend line is basically, it's kind of like your candlestick approach that I'm talking about here. So a lot of your Forex traders, a lot of your stock traders, a lot of your precious metals traders, your exchange rate traders will know what I'm talking about. A lot of my engineering clients understand this very well. But for people that don't understand this, generally markets don't go up in a perfect linear fashion if you look at it on a small molecular basis. So I'm saying you're looking at it on a weekly, a monthly basis, so a small basis. So what you'll get is you'll get in a day, basically a market, should I say, it might jump up 2%. It might have a quick growth rate in the first, couple of, maybe hours. It might go up 2%, then down 1.5%, then up 2% again, then down 1.75%. In the day, let's say it ends at 2% or something like that. What a resistance trend line is it's when basically when a market is going up, generally your ups are larger than your downs, and it continues that way. When it goes down, your actual candle that goes down is larger than the one that bounces back up, and it continues that way, so the market goes down. Now, when it levels out, what happens is there's actually resistance to going up or down. So Melbourne obviously went down till literally later last year, and earlier this year it broke it. So what you'll see here is on the left side here of the actual, this is the daily laid back indices on CoreLogic. You can see this publicly. You'll see here that it was going down and then basically it petered out. So what happened there was the resistance trend line had actually broken. So yes, it doesn't happen the same as stocks, as in you look at it by the hourly or the daily basis. In property, how you look at it is you look at it over generally a couple of weeks. And what happened there is the actual market started to, instead of going down, let's say 0.05% on a daily basis and bouncing back up 0.01% on a daily basis, what happened was it would bounce down 0.02, then bounce back up 0.02, or vice versa, or very similar numbers. So the kind of candle approach and the actual resistance actually broke. And you can see now, because it's broken, what has happened is it started to go up. And that is very common in markets. And it works in a longer time period in property, don't get me wrong, as I said. However, as I said in the past, that is exactly what you want to see happen. That's the best time to buy. So the best time to buy, as I said to everyone, was late last year. And probably to the turn of the new year this year. That's when it was starting to break. And I was telling everyone to absolutely pile in now. If you look at my episode on the property clock, you'll see exactly what I was saying, and you'll see me saying it is going to turn immediately. You can fact check me on that. Look at my I think it's my October property clock update, and then go straight into my January, then also my April, and then you'll see my most recent one in July. You'll see exactly what I was talking about. I said this was happening to everyone. I said it's shifting, it's changing. So this is where I was getting that data from, and it was also on the ground. So this data, in my opinion, CoreLogic is only accurate to 3 months. Real estate's accurate to 12. On the ground is accurate to today. So I wasn't talking rubbish to people. I was telling you the truth of what's going to happen. And furthermore, this is a previous slide that I used in the past, but this is exactly what's going to happen in Melbourne as well. So you can see over the long term here, you first of all got your downturn and stagnation. You can see here, and you got periods of that consistently. So 92 to 97, which is the most similar one to today. 2007 to 2012, a bit of a sort of smaller, should I say, stagnation. And then today is the longest. It's 2017 or 2025. That bottom trend, I think, is broken, and the actual upturn has already started, in my opinion. But you look at the booms, you generally have a major one, then a smaller, sharp one. That's generally how the market works. So you had your major one, as I said, between the late 90s and pretty much 2008. So that was ridiculous numbers, and it was like 150% growth, right? Then you had, basically after that, you had your shorter, sharper one between about 2013, 14 and 2017. That was your other, should I say, short, sharp Melbourne one, right? Now, that growth there alone did probably somewhere between 80 and 100%, so smaller and sharper, don't get me wrong. But the one we're in for here, so I've extrapolated, if you look to the far sort of right of the graph here, where 2025 is today, so it's not much above literally 2017. However, we're in for the the next one is the major boom of Melbourne. It's not the minor, it is the major one of Melbourne. It is going to be big and is going to be sustained for quite a few years. So you'll see there just beyond upturn and boom, I've got 2025 to 2030 question mark. It's because I think this isn't only going to be probably a 5-year upturn and boom. It's probably going to be more than 5 years. The upturn will probably run for a couple, and the boom will probably run for somewhere between 1.5 and 2 years as well in Melbourne. That's what's going to happen. So it's going to be for a very sustained period. So look, if you just want to pause and look at this graph a few times, I recommend you doing it, and then go back to the other things I've shown you. This is showing you exactly what's going to happen in Melbourne. It is the best time to buy. It is so underpriced despite everything that's going on. And we've seen this before. It's no different to what has happened before. So that's what you need to understand in Melbourne. So I've got into all the reasons why Melbourne is the best possible place to buy, but I think it's really important to describe the best areas to buy. And the reason for being so is because these areas have done much better than the average. Now, Melbourne on average, as I've said before and I've shown, has done about 8%, or maybe 8.1 if you want to really narrow it down. But there are areas in Melbourne, and quite a few areas that have actually done 9.5 to 10%, or sometimes even slightly more capital growth. Now, primarily, these are literally the only areas I buy in Melbourne, so I'm going to get into that. And the reason being so is if you have money, you want to park it in the best area anyway. Now, look, you are going to need a minimum of about $800,000 here. And I'm sorry for people that don't have that. Now, look, if you don't have that, check out my videos in Geelong. I'll reach out about Geelong because you can buy for much less than that and you'll still get very good capital growth. But let's just start with my favourite one, and that is the inner west of Melbourne. It's one of the primary regions of Melbourne I like buying in. And the reason being so is because it's the cheapest. You have the best yield out of all of them, and you have some of the best capital growth in all of Melbourne. So where am I talking about? Yarraville, Seddon, Kingsville, Footscray, West Footscray, Spotswood, Newport, Williamstown. It's mainly your Maribyrnong and your Hobsons Bay Council regions. If you want a little bit more land, Maidstone, maybe even in Braybrook. Those are two other good ones also to buy. Now, these areas, you talk to older people, would have a stigma about them, but who gives a shit about a broke older person or someone broke who doesn't know what they're talking about? Who cares about what they say, right? No one gives a crap. You're in it to make money. You're in it to change your future here, all right? That's the reason we're in this, okay? Now, these areas also have some of the highest median income of Melbourne. So, I mean, Yarraville has nearly literally $2,500 a week median household weekly income. That's higher than some parts of the inner east. I mean, the inner city and even the Bayside. So people don't know that. It's got higher income than that. So that's the reason these areas are gentrifying. Incredible locations to buy. I've got literally 3.8 to even 4.2, 4.3% yield here before, on a suburb that does nearly 10% capital growth. So inner west, great area to buy. It suits investors, owner-occupiers and developers, suits everyone, even with relatively low budgets. My favourite area to buy in Melbourne. My second, probably the inner east of Melbourne. Now, where am I talking about? It's probably no further out than I'd say Blackburn to Burwood, right down to the sort of Malvern, Ashburton boundary, right up to kind of your Doncaster boundary, right across to sort of Ball and North Q East, that area. That's what I'm talking about. Now, it looks a lot like this, so suburbs like this in Camberwell, tree-lined streets, beautiful, similar to the inner north of Brisbane, your Hamilton, Ascot, Clayfield, your North Shore of Sydney, very similar to that. Generally bigger blocks, generally your period homes, your larger homes as well, sometimes even on acre blocks, often quarter acre blocks. Quite an expensive area though. I mean, you're probably going to need minimum 1.4 to 1.75 million for this kind of area, so it's not going to suit everyone. Who it suits is owner occupiers who have families. Great area for schools, very prestigious private schools here. Great access to the city, great lifestyle. Also, if you like tree-lined streets and greenery, very beautiful for that. It suits developers because some of these suburbs still do have quite, I'd say, development pro stock. It's quite good for that. And it also suits you, say, your wealthier investors. So especially if you're like a higher end professional, doctor, surgeon, lawyer, accountant, business owner, you might even be a tradie, for example. I know plenty of tradies who earn more than doctors, to give you an idea. But good for them if you want to eat up a lot of your tax. You might, for example, have a two to two and a half, maybe more borrowing capacity. You might want to buy a couple of properties. The first one you want to buy, let's say $1.5 million or something like that. Eat up a bit of that, your actual tax you're paying if you're on the top tax bracket. The next ones you buy in maybe companies or trusts or something like that. That might be your strategy. So good for people like that. Good suburbs. I mean, Box Hill, Mont Albert North, Hawthorne East, all really good. Q East is good. Ashburton. I mean, some of these suburbs here I've just mentioned have done nothing, especially somewhere like Box Hill for like 7 or 8 years. Similar to the inner west as well. The suburbs there have done nothing for 7 or 8 years. It's similar to somewhere like, Yarraville, West Footscray there. Braybrook's another one. Even Newport as well. Here, as I said, Box Hill's a good example. Done nothing for 7, 8 years. All of those suburbs I mentioned have pretty much had long-term growth of 9.5%. Right up to even higher. I mean, Kingsville in the inner west has done 10.4. I think Box Hill's done 10.1 or 10.2%. So very, very good suburbs and that great areas to buy. Another area, inner south/southeast. This area alone, to give you an idea, great area to buy. Where I'm talking about is probably no further south than I'd say Caulfield South, right across to probably Elwood. That's probably your boundary of it, right up, sort of follow the Monash Freeway along Malvern there, right up to Kooyong, and then right across to Port Melbourne, south of the Yarra River. So this is a really good area here as well. The good thing about this is you can have varying budgets, right from about $1 million right up to, about 1.5, 1.6. Does suit. Now you can obviously go higher than that if you have more money. So, and this will suit everyone. Look, developers do need a lot more money. That you probably need at least, I'd say, 2 to 2.5 million for a developer. Some do have that, so I'm not excluding you. But great for investors. Great for also owner occupiers. Great area to live near the water, near the city, near all the good schools. Excellent area to live. Very high incomes in also close proximity to all the job hubs near here too. Suburbs that have done very poorly in recency but very well over the long term: Port Melbourne, Windsor, Brahan, South Yarra is another one. Balaclava is an excellent example. St Kilda East is another one. 9.5 to 10% plus capital growth here. Sometimes even more in the streets. Albert Park's another one, but it is more expensive. All really good. I mean, I've had investors buy properties here with nearly 4% yield, even in Prahan and, should I say, Balaclava here. Great areas to buy. Long term, if you're very wealthy and you're an owner occupier, I mean, somewhere like Albert Park, Port Melbourne, Albert Park has the highest price per square metre in all of Melbourne. So it is literally one of the best places to buy in the country. Port Melbourne is also one of the best in the whole entire country. And those areas are like 2.5 to 3K from the CBD. South Melbourne's another one that's like 1.5 to 2 from the CBD. Very hard to find one there that's relatively decently priced though. But these areas are pretty much your best lifestyle areas in all of Melbourne. I don't see how you can do wrong. You're in like the Monaco of Melbourne. That's the way I describe it. So, really good area here. One of my favorite in all of Melbourne. Yes, you need more money, but great area to buy, as well. My last primary area is your inner city / inner north. So it basically takes your northern end of the Yarra boundary right up to about Alphington, straight across pretty much to, I'd say, about Aberfeldy, then right down the eastern side of the Maribyrnong River. So it's your Kensington, Flemington, right down into the CBD there. So these areas, don't get me, yes, developers can buy here, but probably a little bit better for your investor and owner occupier. And it's simply because the lots are tiny here and the development stock is so scarce that when it comes on market, generally, I kid you not, it'll sell for like minimum 2 to 2.5, often more than that, often over like $3 million or more because it's so scarce. But your smaller lot properties are great for owner occupiers who like a sort of inner city lifestyle, great for investors who, love, should I say, longer term capital growth and decent yield. I've got even properties here to yield literally like 3.5 to 4.1%, which is insane numbers. Suburbs here that I really like: Cremorne, Richmond, Collingwood, Fitzroy North, Clifton Hill, all really good. Brunswick East is great. Aberfeldy is really good. Some parts of Essendon, some parts of Flemington, Kensington, all really good suburbs. 9.5 to 10% growth, like long term. And I've done nothing for like, depending on the suburbs, 6 to about 8 years, right? Now, to give you an idea, Cremorne, for example, has the second highest median income in all of Melbourne, second to Kooyong, which it neighbours straight across the Yarra, right? Now, because of this and it's done nothing, look at the opportunity you have to buy it. Like, it's like $1.3 million at the moment. And I mean, it's one of the best suburbs in all of Melbourne. It's basically MCG suburb of Melbourne. Now, don't get me wrong. Some of the suburbs I would hate to live in. I wouldn't want to live in them. Like, I don't personally like Richmond as a suburb to live in. Don't get me wrong. Some parts near Cremorne and the parts I'd say on the eastern side are much better than the parts near the Bronx public housing. There's just junkies everywhere. It's disgusting. I don't like it. But I mean, regardless of that, you wouldn't park your money right next to it, but parking your money in Richmond is one of the best suburbs long term. You have very high median income. People can afford higher rents there. Great capital growth. So it's a no-brainer, right? If you have that money and you like the inner city, it's a great suburb to buy, and there's a great areas to live here too if you like that inner city lifestyle. So, I mean, Brunswick East is a great one, for example. Fitzroy North's a really good one. All really, really good suburbs. You probably need about $950 to $1.3 minimum to buy here, but I mean, it's still affordable for most professionals. So, really good suburbs in that. Now, the last one I want to get into, and I wouldn't call it primary. I'd say it's only partially. And I've put this here is the Bayside, and I put in brackets partially. And the reason for that is because when Melbourne was locked down, especially you sort of say bubble, a lot of people actually moved to the Bayside, and there was actually quite a bit of demand, especially post-COVID, because of what happened. So there's some suburbs that have done 40 to 60% capital growth in the Bayside, believe it or not. And generally in a property market cycle, in the growth cycle, you get somewhere between 60 to 120% growth generally. Now, yes, you do get anomalies like this video is about, where you might get even more. So in Melbourne, for example, between about 97, 98 and 2008 to 2010, depending on the market, on average, it actually did about 150%, right? Now, I'm not saying it's going to do that. I think it'll probably do upwards of 100% in this growth cycle. But even if you take the larger part and your suburb's done 60%, let's say you say 120%, that's 50% of the capital growth that has already been eaten up of the suburb. And also not only that too, but if it does less, it's even more of it that's already eaten up. So that's why I say it's only partially it's probably a secondary area, I'd say. There are primary suburbs that I would consider here though. And they are mainly, I'd say, Moorabbin, Hampton East are good examples of that. Hyatt's another good one. Ripponlea, Elstonwick are pretty good as well. Brighton East is another one. Some parts of Sandringham, and Cheltenham's probably another one there too. Now, in saying this, it's not all parts of the suburb. You do need to be in the right pocket of the suburb. These are very underpriced though. I mean, like, exceptionally underpriced, very good income there, great lifestyle. People want to live here. Pretty much everyone wants to live here. Great area for that. I mean, no complaints there. But what I'd say is, just coming to the end of this episode with this segment, is that when I say buy here, I'm not talking about the whole suburb. I mean, of the suburb alone, you're probably only buying in 15, maybe 10 to maybe probably not even 15, 10 to 30% of suburbs worth buying in. Of that 30%, right, half of the properties alone aren't even worthy of buying, right? So that knocks it, even if we take the large number of 30%, that knocks it right down to literally, I kid you not, 15%, right? Now, we're already narrowing down the suburbs. Now, of that 15%, right, only about, I'd say, 1 in 3 are probably even have the right are the right dwelling or have the right actual characteristics of the dwelling. So 2/3 of them aren't. So if you take 2/3 of that off, it's 5% we're right down to, right? Now, of that 5%, what I would say is, of the dwellings, so you got to remember, a lot of the suburbs there in the right pockets are very tightly held. These suburbs are already tightly held. The right pockets even more tightly held, right? So of that alone, you got to think now, that alone, you're going to have, let's say, something on the lines of, I'd say, probably 5% of the suburb is even actually available to purchase. So 5% of literally a total amount of 5% is what? That is, I mean, what, 0. It's like nothing. It's like 0 point something percent of the suburb. Now, of that, they've got to be correctly priced as well. And maybe I'd say 1 in 4, so a quarter of them are well priced. So it's a percentage of a percentage that is even within the grasp. Now, I'll tell you right now, I reckon 9,999 people out of 10,000 even know how to get the right stock, and probably half of them, only half of them, so it's probably 1 in 20,000 actually even know how to bid for it properly. So If you're someone who's serious about buying in any of these suburbs, I strongly suggest you reach out via www.compoundinvest.com.au/inquire. I do offer free, obligation-free 30-minute consults. It's just a phone call between me and you. And I think it'd be very good for someone, especially who's serious. Yes, I am a buyer's agent. Yes, I buy in these areas, but I do care about these sorts of things and these markets. Now, what I'd say here is as well, even if you're not looking to do it right now or you just want to have a chat, it's a good idea because the strategy itself is even more important than the purchase, because if you stuff up the strategy, the purchase is going to be stuffed up completely anyway. So what you need to do here is really reach out. I'd say, look, I'm from a working class background. I'm from a literally farming family on my mum's side, immigrant family on my dad's side. I do really care about people here. I do these videos not to do bullshit. Look, I tell people suburbs, I tell you why. I'm not like everyone else who hides behind a corner and thinks they know everything. I'm telling you literally publicly available data here. And I do that because I care about people. I don't want you to stuff up the biggest financial decision of your life. Yes, for $1 million purchase, my fee is probably somewhere between $12,000 and $15,000, depending on how much it is. But I'm telling you right now, a 5% mistake at $1 million is $50,000. So you're making minimum probably $35,000 on the way in. 999 people out of 1,000 will stuff that up. I'm saying the purchase price here, 9,999 out of 10,000 won't even get the strategy right. That's just the truth, right? Now, on top of that, I get bank vals. So when I walk into a property, we're making money on the way in on a bank val anyway, because I know a lot of people who work at these places. I get them before we even buy a property. So that's a bit of my strategy. But anyway, look, I really appreciate everyone watching this video. Yes, it was long, but I hope it's been of great value to everyone. Have a great week ahead, and I'll see you on the next one.